This is the hot hand fallacy, the belief that a string of successes predicts future successes. The flip side is the gambler's fallacy, the belief that after a series of losses, a win is due. Both are born from the same cognitive error, an inability to accept the profound role of randomness in financial outcomes. Markets are not elegant machines to be figured out. They are chaotic systems driven by the unpredictable emotions of millions of people. But admitting this means admitting we are not fully in control, a truth so psychologically uncomfortable that our minds will construct elaborate fantasies to avoid it. We create complex trading systems, follow intricate charts, and listen to gurus, all in an effort to impose order on a fundamentally disordered system. This illusion of control is then supercharged by one of the most primal human emotions, the fear of being left behind. Social proof is a powerful evolutionary tool. If everyone in your tribe is running from a rustle in the bushes, you don't stop to analyze the sound. You run too. In the modern world, this translates into herd mentality, often weaponized as FOMO, the fear of missing out. When you see stories of ordinary people becoming millionaires overnight by investing in a meme stock or an obscure cryptocurrency, a powerful psychological trigger is pulled. It's not just about greed, it's about the deep-seated anxiety of being the one person who missed the opportunity of a lifetime. Your neighbor, your co-worker, your nephew, they're all getting rich, and you're not. This social pressure can overwhelm any rational analysis. You stop asking, is this a sound investment? And start asking, can I afford to not be in on this? This is what creates parabolic price spikes, where an asset its value detaches completely from its intrinsic worth and becomes a pure reflection of collective hysteria. But the trap doesn't just snap shut when you buy in. The real psychological torment begins when things go wrong. Let's talk about the profound asymmetry of pain. Behavioral economists have demonstrated that the psychological pain of losing $1 is roughly twice as powerful as the pleasure of gaining $1. This is called loss aversion, and it is the single greatest saboteur of rational investment strategy. It's why people will irrationally hold onto a losing stock, watching it bleed out day after day. Their logic is warped by pain. Selling would mean crystallizing the loss, admitting a mistake, and experiencing that intense psychological sting. So instead, they hold on, praying for a rebound. This is amplified by another mental flaw, the sunk cost fallacy. We overvalue something we've already invested time, effort, or money into, regardless of its current or future value. You think, I've already lost so much, I can't sell now. In reality, the money is already gone. The rational decision should be based solely on the investment's future prospects, but our brains can't let go of the past. We become emotionally chained to our mistakes. To protect our fragile egos from the pain of these mistakes, our minds deploy a powerful defense mechanism, the confirmation bias. Once we've made a decision, like buying a particular stock or investing in a specific asset class, we subconsciously begin to filter reality. We actively seek out news, opinions, and data that support our choice. We click on the articles titled "Why Tesla is Headed for $1,000" and scroll right past the ones detailing production challenges. We join online communities and forums filled with other believers, creating a self-reinforcing echo chamber. Any information that contradicts our belief is dismissed as FUD, fear, uncertainty, and doubt, or attributed to bad actors who simply don't get it. This isn't just about being stubborn. It's a cognitive process designed to reduce the mental discomfort of holding conflicting beliefs, a state known as cognitive dissonance. We would rather warp our perception of reality than admit we might have been wrong. Everyone is consuming the same biased information, validating each other's decisions, and shouting down any dissenting voices until the bubble's eventual violent pop. Underpinning many of these manias is a final simple illusion, the scarcity deception. Our brains are hardwired with a simple heuristic: If it's rare, it must be valuable. This was a useful shortcut for our ancestors. A rare source of clean water or a scarce fruit tree was incredibly valuable for survival. Today, this same mental shortcut is exploited. Diamonds are not intrinsically rare, but their supply is masterfully controlled to create a perception of scarcity that justifies their high price. Limited edition sneakers, hyped up art drops, and non-fungible tokens all prey on this exact principle. Cryptocurrencies, with a mathematically fixed supply like Bitcoin, derive much of their narrative power from this built-in scarcity. The value isn't just in its utility, it's in the story that there will only ever be 21 million. This artificial scarcity triggers our ancient impulse to acquire and hoard, short-circuiting a rational analysis of whether the asset has any fundamental use or value in the first place. We chase it simply because it is limited, so we see the pattern. It's not that we fail to learn from history, it's that we are biologically ill-equipped to do so. The modern financial world is an alien environment for our Stone Age minds. The very cognitive shortcuts, our reliance on stories, our desire for control, our herd instincts, our aversion to loss, and our attraction to scarcity that ensured our survival for millennia are the exact same traits that now lead us into predictable, repeatable financial ruin. The market doesn't just reflect economics. It reflects a distorted, amplified image of our own psychological flaws. Every bubble, from Dutch tulips to digital tokens, is a monument to our own irrationality. The illusion isn't in the market, it's hardwired into the observer. And knowing this, knowing that the source of the error is embedded in your very own thought processes, the true question becomes terrifyingly clear. Is it even possible to escape the next illusion?